Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that will fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
All right. Good morning, everyone. Welcome to the Friday opening playbook for October 17th, 2025. I am joined by the famous and loved Nathan Tucci.
Yes, that is how everyone refers to me, obviously. Thank you, Dave, for that.
Looks like
Let me just
a
get
little
my
bit of
chat
a
open here. Hello, everyone.
Strong day so far?
Yeah, well, it's crazy. It's mixed. It was really weak overnight. It looked like it was going to be a horrible open. Then we rallied closer to break even. Then we dropped down to 0.3%. Then we bounced up to positive 0.3%. Now we're slightly red again. So we're getting a mix of everything right now, which I think just pushes us in the direction that we've been talking about. The market's definitely becoming more volatile in the real sense of the word. How do we take advantage of that or survive that in some cases? I'm currently trying to survive my shotgun Thursday trades because CCJ and GDX are probably my two favorite, and they're both hammered, which I guess is always a good reminder of why, discretion is so hard. Honestly, I'm not even being sarcastic. I'm saying, like, seriously, picking your bets without some systematic edge really is challenging. I've had mostly a good year on the discretionary side, but as the market gets more volatile like this, I think that becomes harder and harder. And obviously, that's why I really like the mechanical strategies where I'm not kind of picking a direction, picking a timing, picking a ticker, just relying on kind of what the data shows. So we'll cover the shotgun Thursday trades in more detail Friday. Hopefully a couple of these will turn around. We've got some hope for TSM and and a couple others. So Visa is looking good. Let's see. QBTS, which is on the put side, is looking decent. Yeah, looking pretty good. We are down 4%. So that one's looking pretty decent.
You're not sharing, by the way, if you want to be.
No, I'm
Okay.
purposely not sharing because we're not supposed to go through them in detail until closing
That's
playbook.
right. That's right.
But yeah, we're getting
Just that somebody yelled at me yesterday for not telling them when they weren't sharing. So I
don't know who would do that, Dave. Who would yell at you for something like that? Well, there are a couple of things to cover. You know, Fridays are sometimes a little bit quicker because we get into the Ask Me Anything or Ask Us Anything. Sometimes they're a little bit quicker, but if you guys have questions, I'm happy to stick on and answer those. That's what we're here for. I have a couple that I want to cover, and then Dave and I are going to do something a little crazy here with weekend options, which I'm looking forward to. So excited about that. But one of the things that we've been talking about a lot, and I'll pull it up here. Let me actually pull it up on the screen here. Here we go. Share screen. We've been talking a lot about this guy because this is the first time that I can remember in quite a while where the markets have been as close to all-time highs as they are right now, and we've moved all the way past neutral, all the way past fear, and into extreme fear. I think it was actually even a couple points lower before. And so it's a really interesting scenario. And by the way, I would actually love to know in the chat you guys' take as regular retail investors, what your take is on why things feel so fearful. Yeah, the volatility is picking up a little bit, but we're not talking about anything too crazy. And the markets are very close to all-time highs. We're coming off several of the best months the market has seen in a decade, or at least since COVID. And so why, I would love to know, in your opinion, why you think things are so fearful right now. Is it the government shutdown? Is it other factors? Is it just that looming feeling of we've gone up for so long for no reason and another shoe has to drop? But one of the questions is, okay, well, what do you do in this kind of market condition? Oh, I'm getting pop-up ads. In this kind of market condition where we are still bullish by every kind of technical sense and even fundamental sense, and yet the market is in extreme fear. Well, I think there's a couple things, and we'll talk about some of them a little bit as I get into the Q&A, because there's a couple questions I want to run through. But one of the things that I think you can do, Graham's on now, so don't bully me, Graham, and tell everyone how boring I am when I say this. But I think one of the things that you can do if you find yourself in this situation where you have a lot of fear is you can use covered calls. You can say, listen, fear is high, so therefore premiums are high, but we're still in a very bullish market. And so I want to collect some of that fear premium, but I'm not ready to close my stocks because the market's bullish. So why would I be closing stocks right now? Well, this is where that covered call strategy actually can come into play because we are starting to get a little premium on those options. And so there are a couple guidelines that I think are worth noting for how to do a covered call. But the simplest thing that I would say to you is if you want to do a covered call strategy, you want to get some extra premium on the stocks you own anyway, I would say do it where you are not taking a haircut on the normal movement of the stock. Make sure that you are at least requiring the stock to be an outperformer in order for you to get called out. What does that mean? Well, if you're trading AMD like I am, as a matter of fact, I'll do one on AMD just to show you here. So let me flip over to my other screen and I'll show you an example of this.
I don't understand the haircut reference.
You wouldn't. It's for other people. There's QBTS, by the way, which Alex gave us puts down 5% on the day. So,
nice.
There's
some speculation going on. Jamie Dimon said it this week about cockroaches coming out of the kitchen with bad loans, credit crisis potentially. I know that's what's causing some of the fear going on in the background.
Yeah, I mean, absolutely could be the case that there's going to be, I mean, obviously the regional bank failure, things like that. But usually I would say, I don't know if this is exactly your experience, Graham, but I would usually say the S&P trumps all. When the S&P is up, we simply just don't see the fear picking up, even if it would make sense. And it's rare situations where that's like the behind the scenes fear is as high as it is right now. This is AMD. You can see AMD has been on a decent run. Obviously, got the big gap up. It's at 233 right now. The high's at 241. And so this is the one that I wouldn't mind doing a covered call and grab some premium in case we get a little more shakeout. And then you have to pick, okay, what strike am I going to sell premium at? I have 500 shares because I closed to 500 after the big gap, which I left them on. But I have 500 shares right now, so I could sell 5 calls, but that doesn't really matter. What matters is what strike versus what premium am I going to get? Well, the way that I would do it is I would simply say, listen, I'm okay to get called out if AMD way outperforms. I get some value out of the stock and it way outperforms. What I don't want to do is look at those really juicy premiums right around the current price and say, oh, those are really good. And so I should, sell a covered call at that range, because at that point, you should just close the trade anyway, because you're just going to neutralize the impact of the trade. And so if you have stocks where you want to sell a covered call, I would say make sure you put yourself in a position where the stock has to overperform in order to hit that level. The cool thing about that situation is if it just performs regularly, and that's the beauty of a covered call, if it just performs regularly, you're going to get the premium from the covered call, and you're also going to get the performance of the stock. So let me give you an example. So here's AMD. Obviously, AMD had the big gap up, but I think a regular week for AMD is just like a 2% move. If you put up the ATR, you probably get something in that like 2% range, even though on a day-to-day basis, it has had some 4% up days, some 3% down days. But if you look at a traditional week, even when it's grinding up, a couple percent, net move. So the beauty of a covered call is that if I sell a covered call up here, let's say at 242.50, and AMD goes from 232 to 240, I just made $8 on the stock that I own, the shares that I own going up $8, and I made the premium of the 242.50 that I sold because it didn't quite get there. Because the way that a covered call works, for those of you who maybe aren't totally familiar with the mechanics here, if you sell a covered call at a certain strike and the stock expires above that level, then the shares are going to get called away from you. But if it expires below that level, then you're just keeping the premium for selling that call because it didn't meet that criteria. You're basically getting paid to make a promise, to make an offer on the stock that, hey, if it gets up to 242, I'll sell it in this case. If it's below that, then I just keep the premium. So what you can do is you can go over to the AMD's chart. I can go out 7 days, so a week from now, go to single, okay? And I can say, okay, I'm not going to sell a 232.50. That's a 50-cent move. That's a 0.1% move. Sure, there's some juicy premium in there, but if I'm going to do that, I might as well just sell the stock, because the risk reward of keeping the stock open versus getting called away right at that price doesn't quite make as much sense. But if I go all the way up to the 242.50 here, you can see I can still get some pretty good juice on these options, while at the same time giving myself $10 of room for upside move in AMD. Okay, so the first thing I would do is I'm going to go for an outsized move. That's like 4.5+% move on AMD. If it makes that move and I get called out, I can live with that on AMD. Now, obviously, if AMD has another crazy shoot and it runs up to 260 a share, well, then I'm going to be really bummed because I'm losing a whole bunch of extra value from the stock. But you got to make that decision going in. You have to be confident going in that if it makes a certain move, you're okay with that move getting called out. So the next thing that I do, so the number one, make sure that I'm going for an outsized move on the stock. And then the second thing that I always want to do is use a limit order where I'm going for a high cost. I'm asking for more than the mid price. So the mid price is 435. The way that I do covered calls is I always start with a much more aggressive, because the way they work is the stock bounces around. Sometimes you can get filled for some really juicy premiums. That's the benefit of selling a call, because why? Most people are buying calls. So when you're selling a call, a lot of times you get the benefit of some of that demand picking up on the buy call side. You're receiving that as the sell call side. So even though the mid's 435, I'm going to set mine at like 475. I'll do, 5 shares that I'm selling, or 5 contracts that I'm selling, because I have 500 shares. So I'm selling 1 contract for every 100 shares, and I'm going for a juicy premium. You can see here, I can make about $2,300. Now, the goal here is for that just to be bonus cash. For AMD, hopefully it finishes somewhere between 233 and 242.50 next week. I get a little upside on the stock, and I get $2,300 in bonus cash. That's the idea of a covered call. So this is one thing you can do. I'll send that off. Look, that was a perfect example. It filled instantly. I should have went for even more premium there on my AMD, because a lot of times when you sell those calls, because you're on the receiving end, and like I said, most people are buying calls, you can get juicier. So start well above that mid price. I should have started at $5 and try to get filled there. But that's one idea. If you find yourself in this situation where you are feeling the fear, you're seeing those premiums and you're concerned, but you obviously don't want to sell your stocks because the market is mostly very bullish. Well, that's one strategy that you can use. So, Graham, hopefully that wasn't the most boring thing ever, because I know opening and closing playbook is for, double digit, triple digit gains on options, and covered calls are a little more on the boring side. But I think, this is one market condition where it can make more sense for people.
It's definitely nice to have a stable income generating sort of strategy, especially in uncertain times like this. Like we talk about all the time, and we really haven't had a super, super high conviction buying opportunity in a while where everything lines up. Covered calls are a great thing to play when you don't have a 5 out of 5 star high conviction across the board. Definitely love this sort of method. Actually, Nate, I don't know if you know this. I've been with Flo and I, we've been testing out essentially a covered call strategy on the S&P, except we're not buying 100 shares. We're just buying a longer dated call. So it's a calendar spread.
Yeah, it's almost like a calendar spread is almost like a synthetic covered call in a way.
Exactly. So we're basically doing that covered call with the 0 DTEs right now, running that around, and so far it's been pretty stinking awesome. I don't know the exact stats. I don't want to make them up. Now I do. We've done 12 trades, won 11 of those, and the one that lost only lost 6%. So
Wow.
Well, I think that when you first started talking about doing the synthetic style, I think that was what immediately appealed to me, was that I like the overnight trading. I like taking those swings, but usually I am going to lose the whole thing when I'm wrong. So because you have that, that extra piece in there, you can actually take some more managed losses, which over time, obviously the risk reward, everything else looks really good. And yeah, overnight actually should have hit, because we got a big head start yesterday and then a big boost, even with the volatility being a little crazy and Phil's coming with a little more challenge. You should have hit your overnight options.
Nate, I took the overnight options and it literally just filled for me.
Okay. Yeah. So I mean, honestly, I'm pretty thrilled to have a perfect week on overnight options this week, given the markets that we have been dealing with. I'll always take a perfect week, don't get me wrong, but this one in particular with some of the craziness feels extra good. So, okay. I didn't get to read. Graham, did you read the chats? Did anyone have any interesting insights on the fear?
Yeah, so I was very mixed. A lot of people were saying that a lot of it's Trump based, because things feel like a gamble when everything's going the way you expect it to, and all the fear and all that is what you expect from at least what's being indicated. And then Trump tweets something and it throws everything into a tizzy. And so when that can happen any day, how do you strategize? So a lot of people were saying that they've been going for lower profit targets, so that they take what win they can and get out early. And a few people wanted to know you guys, what your opinions are on setting the lower profit targets when we have this volatility plus the randomness of, certain news.
Yeah, that's a good question. That's actually, it actually harkens to one of the questions I already have kind of set up for us to go through. So we'll cover that. If you guys have other questions, start loading those up in the chat. Dave, I have maybe, 8 or 9 questions, just kind of going through my email and some of the questions I've noticed that we haven't got around to that I put. But if you want to scoop up some other ones from the chat and get those ready to fire, you can do that. Graham, what are you looking at here? My beautifully timed Bitcoin trade that I bought at 112?
Yeah. Here's Bitcoin. We talked about this on the roundtable. I don't remember exactly when we did that a couple of weeks back. We talked about Bitcoin and what could happen in Q4. I told you guys, I said, I'll add some options now. I'll give you some options now, but my magic number is 105. We were up here at 120s or so. It was starting to run away from us. And I was like, well, shoot, we may never see it again. I gave you the magic number 105. Why? Because that's where it typically touches That's where the 50-day moving average is. In this case, this is the 50-week. Here on this chart, this is a weekly chart. But you can see the touch and go over and over again. Back here in this is September of 2023, touch and go. Here in September 2024, touch and go. Here just recently, this was in April, touch and go. Now here we are in October. We haven't touched it just yet, but we're pretty darn close to that 50-day moving average. 105 was my number to start adding to my position, which I think is a pretty well-timed buy here. And if you look at the same thing on the 200-day moving average, just for Bitcoin here, same sort of thing. Touch, go, touch, go, touch, go. We are down here to touch. Keep in mind, I'm going to give you guys a trade here. Keep in mind, I do not know if it's going to turn around tomorrow and go to the moon from there. I don't know if it's going to touch twice. So touch twice here, touched actually 3 times here, then went. Touch twice here. So it could touch twice, could touch 3 times, or it could just touch and go. I don't know, but I do have data to show that I'm very, very confident that we are going to be much higher than we are right now by end of year. So I was going to go ahead and throw that out there. If you guys are interested in that, this was that number I was looking for a larger position.
Yeah, that makes sense. I wish I waited till 105, but I'm not afraid to double dip and triple dip on IBIT.
I added some, but I added very light, a contract here or there. Right now at that 105 numbers where I'm like, okay, this is our number. This is where we want to go. Yeah, so I'll type this up for you guys.
I don't mind adding. I've already added twice, and I don't mind adding more with IBIT just because I think the risk reward is good enough, and the fact that I can buy time so cheap with the debit spread, so I can go out. I don't. What expiration are you buying? December.
Yeah, and I'm just gonna wrap it here. It's just too good to be true, in my opinion. It could not work out. I could be wrong. Data says otherwise. So this is a 1-to-1 risk to reward ratio. In other words, I'm betting. All I'm betting here is that by December, mid-December, we're going to be higher than where we are right now. Again, based on this touch and go theory, even if we get a double touch, we will probably be higher. Give it 3 months than where we are right now. So I'll give you guys an out of the money one as well, but I'm going to go ahead and grab 100 of these just to show you guys how confident. Don't feel like you have to do the same as me. I'm going to set a limit price of 50. So I'm risking $5,000 to make $5,000 here. I'm going to let it sit. I'm not going to force it. Use that limit order. Don't force it. If you want to go a little more aggressive, you can bet for all-time highs by December, which is a little over the 70 strike on IBIT. You can see that's what I have here. You can get these for dirt stinking cheap right now. This is a 400% ROI if this works. I'll give this to you here. I currently have some, so I'm not going to add here, but 69 and 70 calls. This is currently at a net debit of 20 cents. So if Bitcoin's at all-time highs by mid-December, that gives us 2 months here. It pays 400% ROI versus my wrap order is 100% ROI. So that's my little fun play for you. And I told you guys every single week I'm going to go do a monthly expiration trade. 1, 2, 3, 4. So this week I'm going to do Bitcoin as well. I'm just going to wrap it for next month or 4 weeks out expiration. I'm going to put $1,000 in. Let's see if I can get filled. I'll bump it if I have to. This is my monthly expiration play. I'm giving you guys lots of Bitcoin trades. I would look at taking 1 or 2.
Yeah, I'm gonna add some too. I've been being fairly aggressive with it, but I just I think again the risk to reward is good enough that it makes sense with the risk to find trades. And for me, if Bitcoin is down and we're just on the wrong side of it, then that doesn't mean we made a mistake. It means it happened to go the other direction and you got, the trade still made sense. I think that's one of the important things. I didn't put that as one of the questions, but I did get a couple of those questions like, oh, what did we do wrong when the market shakes out? Well, guys, if you set up a trade that you like, the risk reward makes sense and everything makes sense, probably didn't do anything wrong. Probably just lost the trade. And that's totally reasonable. By the way, Graham, what do you think about the VIX being down 8.5% today with the market going absolutely crazy?
Let me thread this. Sorry,
I'm talking to you while you're doing your thing. My bad.
10. I need 25 or so. I'm just putting $1,000 a month or a week into these monthly trades. I'm gonna drop 1 contract, ship it off. All right. What do I think about the VIX?
I mean, the fact that it's down 8% today, while the market has just gone
I think here's
wild all
more
day
so
long,
why.
is
We had a crazy pop. I don't know if you guys saw this. I start my mornings pretty early. So I got up at 5 this morning. And look at this. This is where the market was. Down in the toilet. It was down over 1% when I got up this morning. Climbed back up from there. So VIX obviously had a mega spike last night. I think we're just seeing it being counter trend in the market. Maybe it's a little off base if you're looking for an ARB sort of thing there, Nate, where I got a little too excited last night and in the early morning. But I think that's why, because I think, if we open down here, we see the VIX up 10%.
yeah,
So it makes a lot of sense. We're just seeing the flip right now.
yeah. Okay, let me get my Bitcoin trade in here.
Doug, I'm struggling to understand how to calculate an exit price when I know the underlying stock will increase, say, 6.11%. I'm curious, just as a side note, how do you know a stock's going to increase exactly 6.11%? I'm very intrigued by that. But regardless, what I would do, Doug, like let's say we're looking at Apple, and you think Apple, let me get my calculator, is going to increase 249, 101.0611. Go to 264, that's 6%. What you can do here in the options chain, I'm just going to go to, let's say you did the November 21st. In Thinkorswim, there's this thing called Theo price. So I just came up here and clicked Theo price. Hopefully you guys can see this okay. I should have probably blown up my screen. Let me blow up my screen. All right. So I went to Theo price here in the options chain. And now what I can do is say, what happens if Apple, and you have to pick a date too, because options decay. So it's not just like a perfect one-way trend. We'll say by November 7th is up to 264 was our number. So that's $15. We're at $15 here. And then this will tell you Theo price will tell you the value of that option. So right now it's at $12. If it gains 6%, your option will be $20. Hopefully that made okay sense. Doug. Okay, gotcha. Yeah, exactly what I just showed you. Hopefully that made sense, Doug.
I've got questions from the chat. If you wanted those, I thought Nathan was going to do his first.
No, I'll do mine first.
Sorry, I just saw it and got distracted. All right, Nate, you go.
All right. Let's start ripping through some of these on a Friday. Ask us anything. All right. You guys range from defensive trades to wraps, jump trades. How do you choose how aggressive to be on any given trade? I guess for me, there's going to be a couple factors there. Really, what I like to look at is I try to kind of do the math in my mind of what's the probability versus the risk reward. So I'm trying to kind of sort out here. Do I think this trade has a high probability to actually move up? And if so, can I get a good enough risk reward for that to make sense and play out? Or do I think, hey, I like where it's at. It's kind of in a position where I think it's going to at least hold steady. And what kind of risk reward can I get on that? So for me, it's basically just trying to run the scenarios. It's not like, I'm just looking at risk reward, or else we'd always do jump trade, right? Because you'd always get the best risk reward. What I'm trying to do is figure out what is the most likely scenario for the trade or for the chart, and then what different risk reward scenarios can I get? So for like IBIT, I think Graham and I both think IBIT, if it's going to go, it's probably going to move. And so doing a defensive trade on that doesn't make as much sense to me. It's like, if we're going to be right, we're probably going to be right. If we're going to be wrong, we're probably going to be wrong. Same thing with earnings. Like if we're trading it as a binary position, well, then I try to say, okay, well, if it's going to make a move, what are the different structures I can trade to take advantage of it? So that's, kind of what I'm trying to do in those situations is match up what the scenarios actually are for the stock, and then which one of those, works out the best from a risk reward standpoint. Anything to add there, Graham?
No, sorry, I was busy looking at my trades.
Shocker.
I'll tell you one thing, not that you've asked me my opinion, but I'll tell you one thing that I talked about last week when I was doing like the beginner training stuff is that, just because the risk reward is valuable, you have a 10% chance of winning, but you're gonna make 1,000%, let's say, if you win, and it's like a lotto trade, so to speak. It doesn't mean that, if you have a small account and you're looking for reliable wins, it doesn't mean it makes sense for you. You still have to figure out whether it makes sense for you, even if the numbers make sense, because you can't take, if you can only afford 5 trades to lose and you take a 10% win, 10% chances on everything, it's never going to work out for you.
All right, next one. Can I master options trading by using paper money simulated account to build up my experience and confidence? This one, Graham, curious if you have a thought here. I would say no. I mean, you could basically learn the structure of the trade, and I think that's worthwhile to learn like how the actual trade works. You can learn how your broker platform works. I think that's good, but I don't actually think you can simulate like the real, results of trading by using a paper money account or a simulated account.
Mm-hmm. You can definitely get a grip for it, but nothing like having real money on the line.
All right. You were always talking about the market maker move and the implied volatility. How do I actually find that number? So the easiest way to find it is right from your brokerage platform. So on your brokerage platform, like for example, I'll flip over here to Thinkorswim. You can see, boom, if we're looking at IBIT, most option chains somewhere up here are going to have this market maker move right there. So market maker move, kind of the next day's move expected at 0.87. So you can see that's like 1.5% for Bitcoin. And then if you look at the options chain over here, most should actually give you the implied volatility and the move expected with that. So a week out from now, 7 days on the 27th, you can see it's a little blurry because my screen's small, but it's telling me the implied volatility is 63%. That's a $4.27 move expected there. But if I go, all the way down here to 608 days away, obviously the implied volatility is not going to be that much different, right? Still the same kind of asset, but the move itself, because now we're taking into account time, is going to be way, way bigger. So 608 days away, you see a $53 expected move, which is literally like 100% for Bitcoin. So you can use the actual market maker move. That's kind of your overnight expectation, but then you can go into the option chain and look at the implied volatility and the expected move for that as well on a kind of a time basis, which is important because if you're trading options, you're always using time as one of the characteristics. You always have an expiration date. So to have some idea of the implied move or the expected move based on actual time is important. All right. How do you decide when to add discretionary plays versus sticking with your mechanical strategies? I'll let you answer that one, Graham.
How do I decide to add discretionary plays versus sticking with my mechanical strategies? Well, I always do my mechanical strategies. That's why they're mechanical. It's like a schedule. I always go to Orange Theory at 8:30 in the morning every single day. So every time it's Monday, I'm placing a perfect income trade. Every time it's Friday, I'm doing my NVIDIA trade, Bitcoin trades. Discretionary is when we do a lot of times, like on Tuesdays, we'll do our breakdown of the markets. We'll find something interesting that we can point to and say, that looks unique or odd. That's where I tie in the discretionary plays, where we get multiple data points that line up and paint a picture for us. That is typically where I would add, like that Bitcoin trade I just gave you is a discretionary play. It's not a systematic play. It's one based on multiple data points. Lots of things pointing to Bitcoin being higher over the next 2 months. So that would be a discretionary one. Now, Thursday is like the ultimate discretionary play, but I think the shotgun Thursday, that's more of a shoot from the hip. That probably over time, Nate, I would look to make that more mechanical.
Yeah, I would agree. I mean, obviously for me, I love the mechanical stuff. That's the majority of what I do. But a lot of times I like things that don't fit into a mechanical strategy. They don't fit into a system. So that's when I trade them discretionary. Hey, I really like financials, or I really like Bitcoin, or something that doesn't fit into a mechanical strategy, and I still want to trade it. And so, I use discretion.
Yeah.
So this is an interesting one. What does trading too aggressive mean? What does trading too conservative mean? I got a similar question. And I think I would have a little bit of a different answer than maybe most people, because I've heard people ask this question like, oh, if you're worried about losing, you're trading too aggressively. Or if you're scared to lose the money, that means you're being too aggressive. And I think that's partly true. Like, you definitely shouldn't be risking your mortgage payment. At the same time, I still feel uncomfortable when I'm losing, even when I'm trading with relatively small size. So I don't think like the fear of loss or the pain of loss necessarily means that you're trading too aggressively. I think trading too aggressively certainly means you're risking money that you can't afford to lose. Like that part's for sure true. And I also think if you're trading in a way where a series of losses or one bad loss is going to blow up your potential to be successful going forward, that's also too aggressive. And so there are definitely some benchmarks, but I think it's more nuanced than like, hey, just trade with an amount of money that you don't care about losing. Well, for most people, they care about losing, any reasonable amount of money, and they're in the markets because they want to make something significant. So I kind of think that's bad advice. Like the whole, if you're scared of losing, then, or if it hurts to lose, then you're trading too aggressive. Like, no, it always hurts to lose. I think more thinking about, hey, what kind of drawdown am I comfortable with? Am I putting myself in a position to do, more damage to that and hurt myself going forward? And trying to give it like a more, honest look in the mirror answer. And then what does it mean to be too conservative? I think this is one that no one asked, but is actually important. If you're spending all of the time in the markets and doing everything, losing time with your family, losing time that you could be working a job, all of that kind of stuff, and you're not targeting more potential than like putting your money in the S&P, you probably shouldn't be trading. You're probably being too conservative for the potential of your trading account. So I don't have a perfect answer because I think it is very individual based, but I do think they're both questions that you should look in the mirror and try to answer honestly, because I think, being in the right balance there is very important.
I think that's a very, very telltale sign of when you may be too aggressive in your position size. I've been there where you have a position on where you like literally you're at the dinner table and you can't think about anything else in that position you have on. And you're checking the futures market to see what's going on tonight. Is my thing going against me? That's when you're too aggressive. I've been there. Actually, I will tell you exactly when I was there was with my ANET trade, which luckily I have bounced back from and made, accounts doing great this year. I think overall around 50% return on the full account this year, which is insane. But at the point of ANET, I put the bulk of my account into it because I had a high conviction opportunity. Everything set up perfectly. It was the biggest position I ever took. And I lost $80,000 on it in the course of probably 2 weeks. And it was to the point where every single night I was watching it. I couldn't even focus on my family. Like I said, couldn't sit down and relax because I had so much in it. I was overly aggressive on that position, even though the data was right. Again, we always tell you guys, never go all in on one position. Well, I did it there. It didn't work out. Luckily, sticking with the program, the systems paid off this year amazingly. But that was a lesson for me. Hey, that was maybe too aggressive.
Yeah, I think that's definitely right. If you're so distracted all the time that you can't think about anything else, probably a good sign. This is one that we get a lot. Do you recommend that people learn level 1 options before worrying about learning debit credit spreads and other techniques? I mean, for me, this is absolutely not. I don't recommend just like, oh, you should learn regular calls and puts, and then you can worry about more technical or complex, whatever word you want to use. I think that's really bad advice. If I am a new trader, I would learn debit spreads first because you can trade those with the smallest size. You can control, your risk way better, in my opinion. And frankly, I just think they're way more advantageous. So if you think like it's important to, take some hits to the chin and blow up an account first, then yeah, maybe you should trade with regular calls and puts for a while. But I don't think that. I think you should learn the trades that are best for your situation, which for most small accounts, and then I would say for most trading accounts, period, are actually learning proper structures to give yourself the advantages that you want. So I think this is very bad advice that like you should master regular calls and puts first.
Yeah, and just to put an asterisk there, I think you should understand how they work, but that doesn't mean you should trade them straight up calls and puts for 2 years before going to spreads. I think that you're just going to find yourself kind of burnt out, upset, and frustrated while you're not making money. It's because they're kind of designed that way for the most part. There are cases where I will trade regular calls and puts.
Yeah,
but for the most part.
This was a question for me, and then I have one for you, Graham. Why don't I manage discretionary trades with a target in most cases? You guys know I love targets. I put them on most of my trades. But then I don't typically put them on a discretionary trade. Well, the reason for that is basically like the time to value ratio. So for me, if I'm putting on a discretionary trade, even like Bitcoin that I just added some on, if it spikes tomorrow and I'm up huge on the position, I'll probably take profits. The reason is because for me, it's just kind of a calculation of, hey, I risked 10 grand to try to make 20 grand over the next 2 months. And so thinking about that ratio, okay, I'm trying to make 20 grand over the next 2 months. If I'm up 8 grand in one day because Bitcoin spikes, I'll take it because 8 grand in one day on a ratio is better than 20 grand in 2 months. And so that's kind of what I'm thinking about there. That's why I really think about time versus value when I'm in a discretionary trade. And so that's how I manage it. That's why I don't use a target. I mean, you can still put a target on. It's not going to hurt you. You can put a target on that you're happy with and adjust it every day. But the way that I do it is I just watch it. And if it gets to a point where it's kind of overperforming what my actual goals were on that time to value ratio, then I'll take the position early. So for me, that's why I'm usually not using a target on those discretionary trades. And then Graham, this is one for you, which I know you've answered before, but maybe just the quick answer. Why don't you use targets for most of your trades?
I do, I've been doing this for a while. I've done a lot of testing, a lot of back testing, a lot of pulling options manually. I've seen a lot of different strategies, and almost every single time, no target ended up with a bigger profit. There's more volatility. You have a worse win rate. It messes with your stomach more. But at the end of the day, it almost always ended with a higher overall profit in the account. That's why I don't like targets. That's why I like to go for the full thing. Now, that can be very frustrating. Let me give you another example. Today, I have a trade on Oracle that was yesterday about 3% in the money, up nicely. Looked like we would easily cruise to a win today. No target on it. Today, Oracle's down 7%. Don't even know why it's down 7%, but it's down 7%, and we're now going to have a loser. So that's the pros and cons of using a target versus not. I know a lot of people, and I encourage you, don't just do whatever I do. Do whatever makes you most comfortable. If you feel more comfortable taking profits quicker and not seeing that volatility in your account, I highly encourage you to do that. Just because I don't use targets doesn't mean you have to do the same thing. But that is the pros and cons. Over time, the profit's much, much larger with no target, with the right strategy. But they're just frustrating on the flip side. That's the con of it.
Yeah, for sure. By the way, I mentioned someone in the chat earlier said that Alex missed on some of his calls. I'm sure he did. I believe that he did. But the one that he gave on closing playbook was QBTS, and that one's down 10% on the underlying stock. He gave puts. He said put flows on QBTS is down 10%. Now he and I both did CCJ. Maybe that's what they're referencing. I don't even know if that was a flow call or not, but he definitely didn't miss on everything because QBTS is an absolute home run. Puts on a stock that dropped 10% the next day. Dave, are you talking to me?
Yeah, couldn't hear me through the mute. That QBTS should be like 100% gain on the option.
Yeah. Yes. So I believe you that he missed on some for sure. I'm not.
I'm hoping Alex gets a loser here soon so we can drill him, because I'm tired of talking about Alex's winners all the time.
Yeah. Okay. This is a question I got. What is a defensive trade? What does cushion mean? Why is cushion a good thing? So when I say a defensive trade, what I mean is you're giving the stock room to lose value and still win the trade. This would be anything where you're trading where like you're below the price on your line in the sand. So your line in the sand is the price that the stock needs to be above in order to win. And a defensive trade would be like, hey, I'm already starting in a winning position. Apple's at 230, but I put a debit spread on for 220, 225. Apple can go down $5 and I still win the trade. And that's the cushion. It's how much room can the stock go against me and I still win. So the cushion is a good thing because it means your probability of going up or winning the trade is going to be higher. The bigger cushion you have, the higher probability for winning the trade. But of course, you're also trading off your risk to reward at the same time. So you just have to understand the risk to reward and all the components that go along with that. Graham, I'll let you answer this one. Why do you guys sometimes say a wrap order is at a good price or a bad price when setting up a trade? Isn't the price just the price?
That's a good question. Because of the way the spreads work, hopefully most of you guys know this by now, the most you can make is the difference of the strikes. So if I'm buying a 100 strike, selling a 101 strike, the most you can sell it for is $1. If I'm entering, I like to enter with my wrap orders for half that price. So if I enter for 50 cents, sell it for $1. Does anyone know what the return is there? 50 cents to $1, that's obviously a double. That's a 100% return on investment. Now, let's say I enter for 60 cents instead. Do I still get that same profit? No. I don't, because now I'm buying it for 60 cents, selling it for $1. So my profit went from 50 cents to 40 cents. So now I got 40 cents over 60 cents. It'd probably be easier to show this and just talk about it. But that's what, 67% return on investment there versus 100%, just by a very, very slight difference in the fill price. Even like 55 cents instead of 50 cents can make a huge difference.
Yep.
So that's why if you don't know why it's a good price or bad price, just use the calculators until you get the hang of it, because the calculators will show you straight up. Oh, wow, that's not as good as I thought it may have. Maybe at first look I thought it was. Calculators will tell you the risk to reward right off the bat. And again, with wrap orders, we always want to see around 100% return on investment. There's some, it can be 80%, 90%, 110, but somewhere in that ballpark.
Obviously, with a wrap order, you're trading a stock that you expect to move, so you expect that you have an edge, but you still don't want to take a quote unquote coin flip trade with a wrap order with a 60% max profit, because a coin flip doesn't equal 60%; it should equal 100% or more. This is a question that I think is interesting. Should I focus on one strategy until I master it before considering other trading strategies? I don't know what you would say on this one. I don't think it's a bad idea to focus on one strategy. I guess where I think there's harm in that, or potential harm, would be, any strategy is going to have wins and loses, series of drawdowns, all that kind of stuff. And if you have one account, you're trading one strategy, and you're in a rough patch with it, I think that can be more difficult than if you have 3 strategies and you have 1/3 the risk per strategy, and you're just trading a little bit more smoothly. So I could definitely see why you'd want to master it and feel really confident. I'm not sure where I fall in this one, Graham. I don't know if you have a different thought.
Yeah, I do have a thought. I'm just typing back in the chat. If you're brand new to trading, I say that is probably the way to go. You don't want to get overwhelmed. You don't want to get confused. If you're new to options, just get the hang of one thing first and go from there. Nothing wrong with it. You'd rather be, they say, you don't want to be a jack of all trades, but master of none. I think if you're getting started, one strategy that works really well is a great start. As you progress in your journey, you will then start to realize exactly what Nate said, that, hey, every strategy, most of the strategies we do here are excellent over the long haul, but there's really, really hot periods, and then there's some cold periods. Each and every strategy has their own drawdowns. When you have 2 or 3, maybe even more working together, you can smooth out those drawdowns. So that's where I think that more strategies is better. But I don't want you to be overwhelmed. If this is your first day trading, I don't want you to think you need to go get 4 strategies and trade them all. You can. They could be really a great start, but I would fear that you'd be overwhelmed.
Yeah, makes sense. Okay, and I think this is my last question, which is, how can we take advantage of fear in the market right now? Because we talked about that. Fear is up. VIX isn't crazy, but it is 24, which is pretty high. And obviously that extreme fear is in the market. I think because the market is still bullish and there's fear, there's some cool things you could do. I mean, one of them would be the weekend options approach, which we'll talk about in a minute, because it's just total premium base. It's taking advantage of all that extra fear baked into the market. So that's one I'll talk about, and we got something we're going to do for that. But I think for me, when I think about fear, I start thinking about, okay, how can I get more premium out of the market? Graham, what would you say on the how to take advantage of that extreme fear that we just showed on, at the beginning of the session?
Two ways. So I'm trying to respond to the chat and do this too.
I've got all these questions piling up here, so
that's right. How can we take advantage of the fear in the market right now? I think with the VIX elevated, strategies that perform in high VIX. This is a high VIX environment. Over 20 is definitely high VIX. Over 15 is even considered high VIX. There's volatility. There's strategies that perform exceptionally well in these types of markets. One of them is my 60-minute income trade. I split up the testing to above 16 VIX and below 16 VIX, and you'd think you'd have 2 different strategies there. They're so different, the results are. So when stocks are moving a bit faster, take advantage of the strategies that perform well in those environments. Also, we don't do a lot of premium selling here. I have mixed opinions on it, but it can be a good environment for premium selling, even like in the case of what you did earlier, Nate, with your covered calls.
Mm-hmm.
Now, I do have one note for that. The reason the VIX is elevated is because, in theory, markets are moving a bit more. So if you do income trades, if you do sell premium, you're technically going to have the same risk as before. That's my opinion on it. Because stocks move more versus when they're steadier, VIX is low, premiums are cheaper, so it makes sense. They all net each other out. But if you're looking for income generating ways, it can be a better time to at least get the larger premiums. I personally, if I had to pick one of those two answers I gave you, I would just lean into things like 60-minute income, which absolutely smokes it in high volatility environments.
Yeah, I mean, I think certainly there are directional things and non-directional things that will work better or worse depending on VIX. I think the interesting thing about the VIX being high when the market is so bullish is you can kind of do those mechanical strategies that, you know, have a bullish bias and just get a little extra bang for your buck. As long as the market still is up more days than it's down, you get some extra bang for your buck, but still, you know, all the same win rate and things that you would expect in regular bullish conditions. And so that's one of the things that I think we have that's unique right now is we still have quite a bullish market, but still that extra premium on top.
Yeah, and to be completely honest, the really cool thing that you guys should know is that luckily with the way we do debit spreads, we really don't have to care. Like if you're trading basic call options right now and you're buying premium, you are going to just be paying an arm and a leg with VIX high. You're paying more premium than ever. You're going to need that thing to really, really move more than ever to make money. The cool thing about the debit spreads and why I know we've had a lot of questions about what's the wrap order, how do we learn this? Guys, please, if we can post that link in the chat. If you don't have the $1 membership, in there's 4 different recordings that you need to watch over this weekend. If you don't know what the debit spread is or how we're trading debit spreads, you need to learn that because we essentially, it does not matter to us if VIX is at 10 or if VIX is at 30. With the way we trade these debit spreads, we're able to offset almost all of that time premium, almost every single penny of it. And that's why we get such good, clean leverage with them. So that's just a side note.
Yeah, absolutely. All right, Dave, I'm ready for some questions from the chat before we roll into that weekend.
I'm not sure we're going to get to all of them, but I'll do them in the order they came in to be fair to the people who got them in early, with the exception of these two because they were about the stuff that you were training earlier. So one is about the IBIT spreads that Graham put on. There was just a question about why they're multiple and which one to take.
The Bitcoin?
Yeah.
Okay, yeah, sorry about that. I knew when I posted them, I probably just confused people. The initial one I gave you is just the most conservative play on Bitcoin right now. That December expiration at the money wrap order that I gave you, 59.60 strikes. That is just basically saying, hey, this is a really, really good time to be buying Bitcoin. I don't know if it's going to go to new highs, but I just have a very, very good confidence rating here with the data that it's going to be higher than it is right now. It could be a dollar higher. It could be $10 higher. Doesn't matter than it is right now over the next 2 months. If you're right, you double your money. All right. So that's the first one I gave you. The second one I gave you was a more aggressive play. Still that same December expiration, but this time you're saying, I think Bitcoin's going to flip bullish again, which I do. I personally do. But it's going to be a more aggressive play. You have to have Bitcoin move up. It's going to have to be 120 roughly in the spot price of Bitcoin, which right now it's around 105. So it's going to have to move here over the next 2 months. If you're right on that more aggressive play, you make 400% return. So that first one I gave you is just a very passive, hey, I think Bitcoin's going to be higher over the next 2 months, double your money, 100%. The other one is I think it's going to be back to all-time highs, 400% payout. And then that third one I gave you is I've been doing every Friday, just adding a position with a month to expiration, just saying I think it's going to drift higher. Bitcoin was my play for this week's Friday. Every Friday, I just add a new stock in the mix. And that's my trade for that portfolio, if you've been following along with that.
Cool. And then the other question is on a covered call trade, because you were doing the covered call stuff earlier, can you be assigned at any time or only at expiration?
You can be assigned at any time. But you don't get assigned, you get called away at any time. So with the covered call, you own 100 shares and you sell one option, just the most basic form. And if it's exercised, they just take your 100 shares and you keep all the premium.
Yeah. I typically, if you're weighing the money or whatever, people will mostly still be waiting for that expiration date. But, if they exercise it, then obviously you have the shares to balance out. That's why you only want to do the contracts that you have shares for. You don't want to have 200 shares and sell 4 covered calls, which most, unless you have permissions to do it, the broker probably will tell you, hey.
But then you don't just keep the premium. You also get paid the strike of the option, right?
No, you get paid for the strike of the option that you sold.
Yeah, that's what I mean.
Yeah.
The
So you'll
strike of
get
the
paid the difference between
No.
the movement, the max movement that it makes.
Yeah. You initially get paid the premium, but then if they exercise it, you get paid what the option strike was.
Yes, correct.
Yeah. Okay. Any suggestions on how to avoid high broker fees is what this boils down to.
The 2 things I would recommend, and I guess I'll get this off my chart because it's confusing because we're looking at one question and not talking about that question. The 2 things I would recommend are, number 1, just make sure you're talking to your broker. Make sure you're asking them to get the best fees possible. I normally, follow up every couple of months and say, hey, can we go any lower? And I've gotten mine down to, I think, 35 cents per side on Schwab, I think is where mine were at, and they started a little bit higher. So that's the first thing, just trying to tell your broker that you want the best fees and nag them for that. And then the other thing is look for ways to trade less contracts. So if you are trading SPY, you can go up to trade SPX and trade, 1/10 the contracts if you do the equivalent, because it would be a $10 spread on the equivalent, or even 1/5 the contract, even if you just do the tightest spread available, which would be a $5 spread. So trading less contracts is another way that you can do it. You can turn a $1 spread into a $2 spread. Lots of different things you can do like that.
All right, cool. Sherry said, would appreciate a comment on this in a volatile market like we have. What do you think about taking, never mind. We talked about that already. So I'm going to get rid of that. There was a question about how many contracts it takes to, risk $1,000 in various different tickers by CMC. CMC, I would just say you need to take the basic options training that's in that $1 membership that we posted and that's pinned at the top of the chat. If you don't understand kind of how to calculate contracts and all that kind of stuff, take the basic options training and that'll do it for you. It's obviously going to be different in every ticker to reach a certain dollar amount. Larry asked how you deal with stocks that only have monthly options.
I don't trade them very often, but I still keep them on all my watch lists and everything like that, because if the option happens to fit the mold of the trade, I'll still happily take it with a monthly. So it's like, if we're looking for a wrap order that, we want to move on a shotgun Thursday and there is no option, well, then we can't trade it. But if it happens to be the monthly option, then we can trade it. So it just depends on, if it happens to be tradable for that scenario.
All right. Question for Nate from John G. Really liked your lotto suggested play for SPX turnaround yesterday and suggested vertical entry. Can you do this again when it presents?
I don't know if I want to mess up my 100% win rate, John.
Yeah, that's true.
Yeah,
no, I'm keeping an eye on those, especially in this market. Graham mentioned strategies where the VIX is high. I think that's one that fits the mold, although I don't have a whole bunch of great testing on it. It's
still young.
What's that?
It's still young.
It's still young. I don't have a ton of great testing on it, but I think, especially when it kind of gets past that market maker move in the middle of the day, it has a decent probability to snap back within that market maker move. And the cool thing with SPX is if you trade it out of the money, you're not talking about like a 20% income play. You're talking about like 150% on a relatively small move to kind of just get back in that zone. So yes, I'll keep messing around with it. And when I see one that's in real time enough that I can give you the actual trade, happy to share those in Telegram.
All right, cool. Carlos asked with your strategy in DCA, where you entered a call for Orly 108 with a December strike or expiration rather, and the option's down 50%. Do you just kind of hold it at this point when it's still 2 months out and let it ride? Or I don't know whose trade that is. What DCA is not one of your guys' programs, I don't think.
He might just mean like shaky dollar cost average.
Dollar cost average trade. Yeah, okay. Yeah.
But I assume that's a Graham trade. It's O'Reilly.
What was it?
Orly.
Oh, I don't know if I dollar cost averaged on it, but I think Orly is a great stock. I would be buying Orly right now.
I guess the question is, when it's down 50%, do you dollar average it or do you let it ride or what?
No, I don't look to the current P&L to then say, should I add more? I would start at the chart, start at your strategy. Your strategy says this is one to buy, then sure.
Right.
But just because your options are up or down does not tell me.
Yeah, like so, like my IBIT, I added to IBIT, but it wasn't because it was down or up a certain amount, just because I like it where it is right now. So I happened to add to that position.
Mm-hmm.
Like 2 bad trades doesn't make a good trade, kind of thing.
Yeah, like it's it's
Yeah.
not like chasing a trade
Yeah.
is makes it a higher probability than just taking the next best opportunity.
Another like an example of this. If the IBIT trade I gave you, remember I showed you at the beginning, guys, that it has in the past hit that line 2 or 3 times before going higher. So I know my strategy says that, hey, I would not be shocked if it comes, goes back up, pops back down to the 50 line. If that happens, my strategy then says I can add there. I don't care what my options are up or down. I care what my strategy says.
There you go.
If that makes sense.
Yep.
Yeah. Mike from GA said, if VIX was down, why did it take $6+ to bounce us out of O&O?
Well, VIX is still high compared to what we've been trading the last couple months. It's just down 8% today. Like we've been the last couple months we've been trading at VIX of like 14, so we're still very high relative to where we've been trading. Just the fact that VIX is down 9%, today is I think interesting. Just
VIX peaked 100% week in 2 weeks. Last 2 weeks, it's gone up 100%.
Right. Yeah. So we, we're down on the day. The overnight, I guess, gapped 29. So we're down on the day, but we're not down, on any relative basis.
Is it still like mid-20s right now? Like 24?
Yeah, 24. Yep.
Yeah. Okay. Jim asked, under what conditions do you go with straight calls and puts instead of spreads?
Very few conditions for me. The one condition that's common for me is profit pairs, because you want to give it easily the ability to get up over 100% because you're offsetting another side of the trade. And so that's one scenario where I systematically do it. That's about the only scenario where I systematically do it. Other than that, it would just be like if there's an opportunity that I really like that I think has insane upside, then maybe I would throw a call on. But even like earnings and stuff, I'm typically not trading calls.
In a sense, that's still even a spread. It's just not technically a spread. Like you're still kind of like balancing it out. You're just doing it with a different ticker, right? Like,
yeah, I mean,
technically not correct, but I mean, like in some sense, you're balancing it out. You're getting some of the benefits of what a spread would do for you.
The big thing there is that I am, I'm expecting one side to lose in most cases. Okay. And so to have a cap profit on the other side would be very difficult in that situation. Here, obviously, having an uncapped profit if something starts really running is a big advantage.
All right. I've got a few more, but I know it's just about 11. I don't know how far you want to go with this.
Well, we can do a couple more. I do have a couple meetings later, so I guess we should get to our special and weekend options within the next couple minutes. But yeah, you can let it rip.
All right. I actually didn't grab the name, but somebody asked, Nate, if you're still working on testing, updating the daily SPX spread rules that occur every afternoon.
I've had a couple ideas now that we have the tool going, but really no, to be honest. Like I have a lot of things in the pipeline right now, and that one's definitely not the top of the list. I do have a couple ideas, but I'm pretty thrilled with how it's done. Obviously, like a perfect week. This week is a great example of why I think I don't want to mess with the strategy too much. We've had some crazy drops, a 1% overnight move, actually 2 1% overnight moves, and we're still 4 for 4 on the week. And so again, I never want to say no because I always have some ideas and some thoughts, but for the most part, I'm very happy with what overnight options has done.
So am I, but I'll mention, because we were talking about Alex and 1 or 2 people in the chat talking about his losses. I'll throw this out there. He actually posted earlier that he knows CCJ didn't work out, but we can't win them all. Even with a 79% loss on CCJ, we had 103% winner on QBTS, means you walk away with a 30% net gain. So he's facing the music on the one, but overall it's been crushing.
Technically a 30% gross gain. I'll remind him of that later as I look for more ways to ding him after he's been running away with all these good trades.
All right. LKT said, any guideline for max exposure or number of opening trades at any one time? I open an account using money I don't mind to lose all, but I trade 1 to 2% per trade on this. I'm very comfortable. Until yesterday, I was down about 15%, which is about 7 times my average win per day. I believe I'm having too much exposure or opening trades. So question is, what should be the percent for max exposure? Also, I realized that almost all my opening were to the upside, so maybe diversification will help in that aspect too.
Yeah. So the way that I do is really simple. What's the drawdown you're comfortable with in an aggressive trading account? If you're comfortable with a 20% drawdown, which that's probably what I'm comfortable with in my active account. It's a huge drawdown, but for my active account where I don't have all my capital in there, I'm okay with that. Well, if you lose every open trade, is it more than that? Because if it's more than that, then you have a problem on your hands. If you say, hey, the max drawdown I want is 20%, but if I lose every single trade, I'm going to be down 30%, then you have a problem. I also, for me, I'm in the same boat where almost all my trades are bullish. So sometimes I'll look at my account and say, man, I'm pretty heavy right now. And literally I don't have a single hedge position on. And so then I'll fluctuate a little bit. I'll take some profits. I'll put on a two-way extra, like a bonus two-way trade. I'll do a couple things just to say hey, let's be, closer to an 85-15 or an 80-20 bullish to bearish. And by the way, not bearish, actually more usually just like two-way or profit pairs, because I don't actually do straight up bearish almost ever, because I don't believe in just straight up hedges, because those are just, peel away your profits, but something that can go the other direction, where I have that. So again, how much are you comfortable losing? What is the drawdown that you're comfortable with? And if you lose everything you have open and it's more than that, then you have to reassess. I do think it's important to have that question. And if you're sitting here saying, hey, I want to trade overnight options or weekend options, I want to be really aggressive and make a whole bunch of money, but my max drawdown is 4%. Well, then you have to kind of assess, okay, well, then I have to put, the system in that light, because that's totally fine. If your max drawdown is 4%, totally fine. Then you need to be trading, 0.5% risk across 3 or 4 positions, right? Because you have to honor what that max drawdown should represent. If you're saying, hey, I want to be really aggressive, I want to double my account this year, well, then you probably do have to be comfortable with a 25% drawdown in April when things go crazy, right? So just being very honest with yourself is probably the best answer for about half of these questions. Look yourself in the mirror, talk to yourself out loud about what you expect to happen in the markets and what that should look like for your account, what you're willing to do, what you're not willing to do, and then go from there.
Yeah, and it may even help to write down some of the rules that you give yourself and post them there, so you can remind yourself, like, this is what I said I'm going to do, this is what I'm going to stick to, and not go past it. All right, I don't know if this is something we can cover right now, but Andy asked if you have any good advice on how to set up the monitor tab in Thinkorswim when you have so many different programs going. Like he has set up sections for each program, but I'm wondering if there's a better way to organize them. Appreciate everything you guys do.
That's what I do, but I also have my trade trackers up, so that makes it easier as well. So I have the monitor tab. I have position groups for every strategy, and that's how I monitor them. So I think you've probably already done that. But then I have the trade trackers open kind of in a separate tab where I can look at those. So if it's like, hey, I've got a couple positions stacked up, I'm not sure, was this trade part of this trade or that trade, even though I know they're both in profit pairs because I have them grouped. I'm not sure which ones align with which. Well, then I have the trade tracker tab just to shed the extra light on that. We are working on some instruments to make that easier, because I know, if you're like me and you do have 25 trades open at one time in 2 different accounts, so, maybe 50 trades open, including the long-term ones. Managing it becomes a significant part of what you need to optimize, not just the entries and exits and following alerts, but actually, managing what you have open, why you have it open, all that sort of stuff. And so we have some pretty stinking cool ideas to help you guys do that part of the process, because that's what we want to do. Like when I did the dashboard, just to give you a market intelligence idea, it wasn't to give you another trade. It was actually to help you manage all of your trades. And so we do want to be comprehensive in the way that we help you achieve success. And so you guys will, I'm sure, be seeing some stuff on that within the next couple of months. Nothing to do with new cool hacky strategy. I love those. Those are probably the most fun. But all to do with, hey, how do I actually have success as a trader in the market from a more comprehensive view? So stay tuned. You said Andy asked that question.
Yeah,
Andy, I think you'll like some of the other stuff that we'll work on that's more like trader support than it is actual strategy.
Yeah, Nate, we should talk about that at one point, because if it's going to, be a few months before we have some of these tools built, like I might be able to throw together like a Google Doc that they can use to kind of, we already provide the templates for a trade tracker for a given one, and we say, okay, copy this tab and do all the tabs or whatever. But if they want to kind of be able to summarize all that information from the multiple tabs on like a summary sheet, or they want to be able to filter by which account the trade was in or something like that, we could build some things out as like a temporary thing before we have those tools
Yeah. Okay. Well, we can definitely do some, pacing of, hey, in the
Yeah, yeah,
next month we could have this, in the next 2 months we can have this, and
yeah.
go from there.
All right. I have a few more, but it's after 11, so it's up to
All right.
you.
Well, let's file those away for next Friday then. Thanks everyone
Okay.
for all the great questions. We do want to honor your time here and still get through this special we have on weekend options, because if you guys have kind of been waiting around for weekend options and haven't taken advantage of it yet, with jumped into the perfect win rate. Not that it's going to stay a perfect win rate. You guys know the drill on that. But today is going to be a pretty unique opportunity that we're doing to try to just give you an easy chance. It basically goes to that question: hey, how can I take advantage of the market conditions if volatility is going to be a little bit higher? Now, granted, I don't trade weekend options if volatility is crazy because we want to be careful. But when it's kind of in the middle range and still bullish, those are really opportune times. So how do you take advantage of that? Well, weekend options is one of those very premium-based strategies, and it's been insanely good. It has a perfect track record for 2025. And we're going to do a little special today, little fun surprise for anyone who has yet to take advantage of it. So yeah, let's jump into that.
You going to share your screen?
Yeah, I'll get us
I
ripping
had it ready because
right
I wasn't
now.
sure.
All right. Well, I'll let you kick us off here, Dave. But I just want to mention again, this is for people who have not yet taken advantage of weekend options, but you want to get the best opportunity to do that. We'll go through the whole thing. If you guys have no idea what I'm talking about, what is weekend options, we'll obviously go through that, and then we'll get to the end here. And it is a 1 day deal. We did this on the back of that extreme fear idea and a couple other things, but just laying the groundwork for there. I don't want you to stick around under any false pretenses. We are talking about weekend